All right, let's talk about a company in what's probably the most hated industry on the planet: coal. I mean, nobody likes coal, right? But here's the crazy part. This company, Natural Resource Partners, we'll call them NRP, is just minting money. We're talking record breaking amounts of cash. It's this total paradox that just makes you go, wait, what? So, what's the deal here? Is NRP a classic value trap, a dinosaur just waiting to go extinct along with the rest of the coal industry? Or is it something else? A seriously misunderstood opportunity? A cash machine that everyone's just ignoring? That's the big question, right? And that's exactly the puzzle we're going to piece together today. I mean, look at this contrast. On one side, their business is all about coal royalties. Not exactly a growth industry, you'd think. But then you look at the other side and you see record free cash flow. We're talking $313 million in 2023. That's a huge success story happening inside an industry everyone's already written off. So how on earth is that possible? Well, to get it, we've got to go back and look at their pretty wild history. NRP's story, it's a total classic boom and bust tale. You go back to the 2000s, commodities were booming, and NRP was just riding that wave, flying high. But you know how that goes. Success breeds confidence, sometimes overconfidence, and that led them down a path of super aggressive expansion, all fueled by debt. It's a decision that brought them right to the brink.
And man, when things went south, they went south fast. In 2013, they're dropping $365 million on acquisitions with borrowed money, right at the peak of the market. Perfect timing, huh? They're even paying out this huge $22 per unit distribution to investors. But then, boom, 2015 hits and the coal market completely crashes. All of a sudden, their debt is over 5 times what they're earning. By 2016, they had no choice. They had to slash that payout by more than 90% just to keep the lights on. And the core of this whole mess, it comes down to this one number: $1.5 billion in debt. That was their peak in 2015. This wasn't just, oh, we have some loans. No, this was an existential threat. This was the kind of debt that could have wiped the entire company off the map.
And if you were an investor relying on that income, wow, the pain was immediate and it was deep. Just try to imagine your payout from an investment getting slashed from $22 a year all the way down to $1.80. It was just a brutal, brutal lesson on what happens when you use too much leverage in an industry that goes up and down. The company had to hoard every single penny it could find just to survive. But this is where the story gets really interesting. This is the turnaround. Around 2017, new leadership comes in and they just rip up the old playbook. The new mission, it had nothing to do with growth, nothing to do with big payouts. It was about one thing and one thing only: survival. And this quote right here, it just perfectly sums up the new mindset. Forget everything else. The number one priority was fixing the balance sheet. The new management team knew with absolute certainty that they couldn't even think about giving money back to shareholders until the company itself was on solid ground. So what was the plan? It was actually super simple, but they were absolutely relentless in executing it. Step 1, pay down debt, all of it. Step 2, get rid of this really expensive preferred equity that was costing them 12% a year. Ouch. Step 3, clean up these dilutive warrants, basically these things that could create more shares and water down everyone else's ownership. And only after all of that was done would they even consider raising the payout for regular investors.
And you know what? It worked. It worked like a charm. You can see it right here. That mountain of $1.5 billion in debt from 2015, they just chipped away at it year after year until it's now this tiny little molehill of just $140 million. Think about that. They paid off over $1.3 billion. It's just an absolutely incredible turnaround story.
Okay, so that begs the question, right? Where did all that cash come from to pay down all that debt? The secret sauce here is NRP's business model. It's totally unique, and it's the key to why they are such a profit machine, even now. If you look at where their money comes from, it's pretty clear. The lion's share, about 85%, is from mineral rights, and yeah, that's mostly coal. But they've got this other piece of the pie, about 15%, that comes from a stake they have in a soda ash company. And that little piece is super important, because it gives them a nice bit of diversification away from just coal. Here's the best way to wrap your head around what NRP actually does. Don't think of them as a mining company. They're not. They're more like a specialized landlord. See, they own the land and all the minerals underneath it, but they don't dig up a single thing. They don't own any heavy machinery. Instead, they lease the rights to actual mining companies. Those guys take on all the costs, all the operational headaches, all the risk. And NRP, they just sit back and collect a high-margin royalty check. It's like being a toll booth operator for Mother Nature.
Which, of course, brings us to the elephant in the room, the billion-dollar question. How can a business that makes most of its money from coal have any kind of future? I mean, the whole world is trying to move away from it. This is where you have to really pay attention, because the answer is pretty complex.
First off, you have to understand that not all coal is created equal. There are two very different types we need to talk about. You've got thermal coal, which is the stuff you burn in power plants, and NRP is brutally honest about this part of their business. They fully expect that revenue to go to zero someday. But then you have metallurgical coal, or met coal. This is totally different. It's a critical ingredient for making new steel. And the reality is, the world is going to need steel, and therefore met coal, for decades to come. So, okay, you have a clear risk, right? As the coal gets mined, your main asset is literally disappearing. But, and this is the really clever part, this is the pivot. NRP owns the rights to 3.5 million acres of what's called pore space. Basically, think of it as all the empty little pockets left in the rock after the coal is gone. And what are they doing with it? They're leasing it out for carbon sequestration, burying carbon dioxide underground. They are literally turning a dying asset into a brand new, potentially huge income stream that's actually part of the new green economy. It's a brilliant move. All right, so let's pull all this together. You've got this wild history of near disaster, followed by an incredible display of financial discipline. You've got a super smart, capital-light business model, and you've got this forward-looking strategy to deal with the energy transition. So what's the bottom line? What's the final verdict on NRP?
Well, you can really see the two sides of the coin here. The bull case, it's pretty compelling. You've got this gusher of free cash flow, a balance sheet that's nearly debt-free, and a management team you can really trust. The bear case, though, is just as obvious. You can't ignore the fact that coal is in decline. Commodity prices are all over the place. And there's always the risk that the companies actually doing the mining could go bust. It's this classic tug of war, right? Amazing financials versus some really strong industry headwinds.
So when it all comes down to it, an investment in NRP isn't really a bet on coal. It's a bet on a fascinating idea that a company can be so good at managing its business, so focused on just harvesting cash, that it can actually beat the slow death of its own market. Can a beautifully managed sunset actually be more profitable than a messy, chaotic sunrise? That's the real question NRP forces you to ask.